What's up, everybody? Dan again, Stocktrades.ca. Hope you had an amazing new year, an amazing holiday period, and are ready to get back at it in 2021. The markets in January are usually a pretty exciting time. I don't know if it's going to be this year, considering the economic circumstances and the height of the markets already. But regardless, we're going to continue to bring you amazing Canadian content on Canadian-specific stocks. And speaking of that, we're actually going to be ramping up our YouTube content significantly in 2021. We only published about 50 videos last year, one a week. We're planning to double, if not more than that this year. You can expect to see much more content from us. So if you are the 60+% of people who watched this channel without subscribing, if you like it, feel free to subscribe to the channel. It helps us out, and you're going to get notifications on some brand new Canadian content that we're going to be delivering at a much faster pace. In this video, I'm going to be going over two plays in the Canadian markets, one a value play and one a strong growth play. These are two options that you can explore today, ones that I've looked at over the last week or so, and actually one of them we recommended to Stocktrades Premium members back in 2018, and it's had some very nice gains since. Let's dive into it. One Canadian value play and one Canadian growth play. Let's go. So just a quick reminder, Stocktrades Premium, you can join for free in the description below. You'll gain access to some of our custom reports we create on Canadian companies, some stock screeners, 3 of our 10 foundational picks for 2021. There's a lot of content available on that side of the platform, absolutely free. The first stock we're going to look at, one that I've looked at extensively over the last few weeks, is Kinross Gold. They trade under the ticker K on the TSX. They've been one of the best performing gold stocks in 2020, and they actually have a portfolio that I feel is going to accelerate in 2021, and the company should be able to drive more profits due to a $1,800, $1,900 an ounce gold price. So what exactly does Kinross do? Well, Kinross is a senior gold producer here in Canada. The company produces around 2.4 million ounces of gold per year and has a market cap in the $9 billion range, making it one of the largest gold companies in the country. They have 8 mines in 4 different regions, including South America, Russia, North America, and Africa. And in terms of production, approximately 56% of this production comes from the Americas, while 21% comes from Russia and 23% from West Africa. So besides Kirkland Lake, Kinross Gold has the largest gold exposure out of all the gold companies in the country. It is essentially a pure play gold producer. And if we look to the chart here, we can see that around 98% of the company's production is gold, while a small fraction is dedicated to silver mining. If you want to take advantage of an increased price of gold, Kinross is likely where you want to be. Kinross or Kirkland Lake, considering their huge exposure exclusively to gold. So how exactly is Kinross looking to grow in 2021? Well, the company does plan to ramp up production, going from 2.4 million ounces in 2020 to 2.9 million in 2023. This is a considerable production uptick, and it should bode well for the company and investors, especially if gold can maintain these current prices. However, you are going to have to be somewhat patient, as Kinross expects production to stay relatively flat heading into next year, with production of, again, 2.4 million ounces. But as we can see by this chart, in 2022, they plan to jump to 2.7 million. And finally, in 2023, they will hit 2.9 million ounces of gold produced. So obviously, a pure play gold producer has a fairly simple business model. They're quite easy to understand. You want to see them ramp up production while lowering all-in sustaining costs. And Kinross Gold has done just that over the last while. And more importantly, we want to see it grow its free cash flow yield. And as you can see by this chart, Kinross Gold has been doing that significantly, growing its free cash flow yield by over double over the last few years. If we look at the free cash flow yield, it sits at around 10% in 2020, and they expect this to go to nearly 20% in 2022. If we look at peer free cash flow yield, none of this is even close to Kinross's numbers. So Kinross isn't exactly the lowest cost producer. Their all-in sustaining costs sit at around $978 US dollars an ounce. This is still very low when you compare it to the current price of gold. They still sit, in terms of all-in sustaining costs for gold companies, around the middle of the pack. You have companies like Agnico Eagle Mines and Newmont Gold that have significantly higher costs, and you have companies like Kirkland Lake that have significantly lower costs. But all-in sustaining costs are not the be-all, end-all. Company efficiency is another thing that you should consider, and Kinross is driving a significantly higher cash flow yield than its peers. So obviously the company is looking to continually reduce costs. Its Russian operations have significantly lower costs than its American operations. I think mines in their Russian operating area are around $550 US dollars an ounce. It's extremely cheap to produce gold there. And I really think if Kinross is able to increase production while reducing all-in sustaining costs, they're going to be one of the better gold plays moving forward in 2021 if you still believe that the metal has value and the producers have value. So the company obviously expects cash flows to increase significantly moving forward, as it actually reinstated its dividend this year. Kinross is currently sitting on a strong cash position, over $900 million, and it just recently repaid a $750 million revolving credit facility. So with such a strong position, it was pretty much a no-brainer for the company to start giving some of that money back to shareholders. They reinstated their dividend this year. It isn't much. It's only around 3 cents on a quarterly basis. I think it's around a 1.7% yield at the time of filming. But the thing is, Kinross's trailing 12-month earnings come in at around 85 cents. And if we consider that the dividend makes up only 12 cents of that, we can expect that Kinross should be able to grow the dividend significantly moving forward. So there is a chance for some pretty high compounding returns if you're an avid DGI investor, dividend growth investor. This is also a company that is extremely reliable when it comes to analyst estimates and actually meeting expectations. When a company is this reliable, it creates a more stable and less volatile share price. And if we're looking to invest in gold producers, it's always wise that we're looking to reduce overall volatility, because as we've seen in 2020, these stocks are volatile. In the last gold bull market, a lot of companies, they raised their dividends too aggressively. They essentially spent and funded company operations like the price of gold was going to maintain highs. This time, I feel a lot of companies, including Kinross, have more than likely learned their lesson, and they're going to take a more prudent, disciplined approach. They know that gold is not going to sit at $1,800 an ounce forever, so they're planning operations at cheaper prices than that. Analysts figure that this company is going to grow revenue by around 34% next year. If we look at trailing to forward price to earnings, this is a company that is trading at a 72% discount to both forward and trailing price to earnings. This is a company that's trading at under 8 times forward earnings. I truly feel that people are not respecting gold stocks enough, and in this current environment, the price of gold is likely to remain inflated, and it could be maintained above $1,800 an ounce throughout 2021, even further on. And if this is the case, you're going to see gold companies produce significant cash flows during this time. And as a result, if you're looking for a pure play gold option, Kinross is one of the best in the country, I feel, and is a value play right now. This isn't a junior miner that's going to blow you away with outstanding returns, but this is a company that is expected to post increased profits, increased revenue in 2021, and you can take advantage of a discounted share price right now. Kinross was actually one of the best performing stocks in the gold sector this year, and this is coming from a senior producer among many junior miners and exploration companies. This is going to be a little bit of a higher risk play due to its foreign jurisdictions and foreign mining operations. There's a lot that can happen in those areas that would be more unlikely to happen in a North American region like Canada and the US, but still, this is a solid option moving forward. The next stock I want to speak about is more of a growth play, but they do actually pay a dividend, one that has been growing for 7+ years. They're a Canadian Dividend Aristocrat, and I absolutely love their business model, and that is Premium Brand Holdings. They trade under the ticker PBH on the TSX. So back when the markets crashed in March of 2020, there was a lot of investors who wanted to take advantage of panic buying and essentially the defensive nature of grocers. So a lot of them ended up buying Premium Brand Holdings, and they were very confused as to why this stock absolutely tanked in the March crash. I mean, if we look to the chart, we can see that it went from the $102 range in February to the mid $60 range in the middle of March. So in a matter of a month, this stock took a near 40% dive. And I could tell that a lot of people who were purchasing Premium Brand Holdings as essentially a consumer staple stock really didn't understand how this company operates. This is not a Loblaws or an Empire-style consumer staple stock. Premium Brand Holdings, essentially the premium in their name, they buy high-end brands, not discount brands. So those who thought this was a consumer staple stock may have been a bit confused. They are defined as such. They are a consumer defensive stock, but this is a grocer and a food producing company that's going to have more volatility and way more growth than a company like Loblaws. So why is that, and why am I a massive fan of Premium Brand Holdings business model? They drive growth not only organically, but through the acquisition of high-end, smaller food companies. Premium Brand Holdings is a smaller, more niche grocery play here in Canada and the United States. The company focuses on specialty food manufacturing and differentiated food distribution businesses. A few of its most popular brands include Pillars, McSweeney's, Hygard, and Harvest Meats, though the company has several brands both in the processing and distribution areas. They actually just recently made the acquisition of Clearwater Seafoods, which was one of the best performing consumer staple stocks in 2020 due to this acquisition. The company has a presence in pretty much every Canadian province, but also has sales in Arizona, Minnesota, Mississippi, Ohio, Washington, and overall they serve over 22,000 customers. So the company has grown at a pretty rapid clip over the last 5 years. If we look at revenue from December of 2015 compared to December of 2020, they have grown their top line by 183%. So how has it done this? It's done this through a key acquisition strategy, which is actually one of my favorite business models for companies to follow. Ones that can grow through acquisition as well as grow organically. The company's overall growth plan is pretty simple. They target segments of the food industry that deliver specialty, authenticated, or differentiated products and services, along with targeting emerging trends. And again, this is why I speak on the fact that Premium Brand Holdings is not something that's going to hold up well in a situation like we've seen in March, because they're not a company that offers cheap, discounted, essential food products. They are a company that offers high-end quality products like seafood. Its most recent acquisition of Clearwater Seafoods fits right into this mold. In fact, the company states that the acquisition will be immediately accretive and will provide double-digit earnings per share accretion for premium brands. This is another thing that I love to see, is companies that can essentially take an acquisition and instantly have it benefit their bottom line. It doesn't take a very long time for them to synergize an acquisition. So the recent acquisition of Clearwater Seafoods is essentially going to create one of the largest seafood companies in the world. They expect revenue to be in the $1.3 billion range, and 90% of this revenue will be located outside of Canada, which just benefits Premium Brand Holdings even more with its overall diversification. Speaking of diversification, Premium Brands has a multitude of overall brands that lead to a wide product base. So 43% of their products include a various type of protein, 20.7 of them are sandwiches, and 15% being seafood, with the remainder being a variety of other products. So overall, this reduces the company's single commodity type risk. If they have a heavy presence in, say, beef production, if the price of beef were to go up or down, the company would inevitably be more volatile. But they do have a wide product base, which will help them grow more moving forward and protect them against some harsh downside in prices. And to add to that, the company also has a wide variety of customers. 49% of its sales come from its top 10 customers, with only 2 of those accounting for double-digit sales. This too lowers their overall risk significantly. There is a big danger in a company having a very heavy reliance on a single customer or multiple customers for the bulk of its sales. The loss of a single customer can result in a massive hit to revenue and inevitably earnings. The fact that Premium Brand Holdings' top 10 customers, only 2 of them account for double digits in terms of revenue. If it were to lose one of these customers, I'm fairly confident that it would not affect them that much. They'd be able to recover that revenue elsewhere. Whereas, say, if they had a heavier presence, 20-25% in terms of a single customer, if they lost that customer, it would be detrimental to the company's operations. Finally, the company has strong exposure south of the border, which not only exposes it to a much larger market. I mean, they have 10 times the population as us in the United States, but it also exposes them to a stronger currency. 38% of the company's 2019 sales came from the United States. So not only is this a high potential growth play if the company can continue to drive its acquisition strategy to build on its top and bottom lines, it also pays an excellent dividend. Premium Brand Holdings is a Canadian Dividend Aristocrat. They've raised dividends for 7 straight years. They pay a yield of around 2.27%. And although a lot of income investors might look down on a 2.2% yield, it's very important that we look at overall return here. I can't stress enough that investors that focus too much on the dividend payment might be giving up huge overall returns. We can look to a company like, say, Enbridge that pays an 8% yield but has saw its share price shrink over the last 5 years. Or we can look at a company like Premium Brand Holdings who pays a 2.27% yield but has a 21.3% compound annual growth rate on its share price. This is a 23+% annual return on this company. And to add to the fact that it's posting these types of returns over the last 5 years, it's also growing its dividend at a 10.9% clip annually over the last 5 years. So you're getting a 21% increase in share price annually and a 10% increase in its dividend annually over the last half decade. Now, whether or not it will be able to continue doing this moving forward, that remains to be seen. A growth by acquisition strategy requires a much more consistent management performance, but they have been shown to be able to do this in the past, and I'm pretty confident they'll be able to do so in the future. The one thing I do expect to slow, however, moving forward is its dividend growth. Right now, the company is paying out around 85% of earnings and 70% of free cash flows towards a dividend on a trailing 12-month basis. These ratios aren't indicative of a dividend cut, but they are indicative of a company that, if they're planning to grow via acquisition, they might need to use more capital to pay for those acquisitions, and as a result, a 80+% payout ratio in terms of earnings and 70+ in terms of free cash flows, they might want to choose to preserve more of this capital for acquisitions. So I could see Premium Brand Holdings' dividend growth rate dipping down into the mid to high single digits over the next 5 years, but the fact is they're still growing at a pretty rapid clip, and again, I can't reiterate enough total return here. Don't get laser focused on the dividend yield and the dividend growth. And if we look at its 5-year chart, this is a company that has returned over 185% over the last 5 years in terms of dividend adjusted returns. This far trumps the TSX, which has returned around 32%. If this company can continue to make solid acquisitions like it has with Clearwater and all the other plethora of brands it owns, it should be able to drive top and bottom line growth. Whether or not it's at the same pace as they have been going, that's never a guarantee. Growth by acquisition companies you really have to depend a lot on the company's management and the execution of this strategy. But when a company is good at doing this, they tend to grow much faster than others. I think Premium Brand Holdings has a chance to do just that. And that is exactly why we identified the stock for Stocktrades Premium members back in very early 2019. The stock has actually provided some pretty consistent returns since then. So that's pretty much it for the video. Really hope you liked it. You're going to see a lot more of these shorter stock analysis videos from us moving forward in 2021. We look at stocks essentially all day, every day. So we figure if we're looking at them, we may as well bring them to you in a video, whether we like the stocks or not. This is a video of 2 stocks that I really like, but there might be some videos that I post where I looked at 2 stocks that I really don't like, and I'll bring them to your attention as well. We're going to ramp up the content on YouTube in 2021 big time as per a ton of requests. So let me know in the comments below what type of videos you want to see. If you like a shorter, more generic analysis on a few companies like I did in this video, or if you want a more in-depth analysis on a single stock in a video like I did with MindMed a few weeks ago, you need to tell us what you want to see so that we can deliver it. And as always, Stocktrades Premium in the description. You can get started for free. If you do click that link to get started for free and sign up, we do unlock a big discount for you just for giving us a chance. So head down below, click that link, sign up for free, become a part of Stocktrades Premium, helping thousands of Canadians earn more on their portfolios. And again, subscribe to the channel and smash that like button if you like this video, if it helped you out. We'll see you next time.